Want my latest market insights? My latest report, Trend Long AST Mobile Option Update plus 60,000%. Good enough is now available. Scan this QR code or click on the link in the description. Your question, Elias, considering present systematic risk, would you say a hedging position in VIX expiring in mid-January makes sense? Yeah, you definitely have to talk about any VIX trade because right now,
Yeah.
Okay, so what's the deal?
As I've sort of been talking about, I don't think it gets too low. Now, I think people spend a little too much time on the VIX. Like I saw somebody on TV today going on and on about the VIX. Like, it's a great time to buy protection. Well, the VIX doesn't, as we've talked about in the past, look at 2022, we had a market that was down and a fund and the CBOE put protect index was down more than the market. So it's, for me, when I buy protection, it's not short term. Now, you may nail it. You may just, your timing may be fantastic. And maybe there are people who do that better than I do. That's for sure. But for me, I like to give myself a little bit of time. So I will go out a little bit. And I think so. I mean, I think dealers are probably really, really offside. If we do get some reason to get that VIX rolling, it does have the potential to get moving. Right now, it does not care. The correlation, the beta to the S&P has been, I haven't looked at it recently, but we looked at it a couple of weeks ago, Samantha, and it was like dead. It was not reacting, which in one sense makes sense because the market just almost doesn't downtick anymore. So why would the VIX care when the market doesn't downtick? It's a little bit of an unusual environment. We have exceptionally low realized volatility. That is something to be concerned about because it's unnatural. But yeah, I think you could put on some very nice looking call spreads in the VIX. I actually just today I put on some S&P spreads. So bonds is always bullish, but again, when I put some money on the sheets, and it has been an exceptional couple of months. Like, it's a good market. I'm not a genius. I'm taking advantage of it, but I'm also going, okay, I put on some, what did I put on today? Some 640, some March of next year, 645, 65. So I'm not putting on something a little bit too short term because seasonally wise, I mean, I don't know, can we put much value on seasonality when we've completely ignored it over the last couple months? Well, probably, because the last couple months tend to be kind of strong. Now, when everyone thinks something is the case, then that's probably when it breaks down a little bit. So if everyone thinks we're going to get a big
Also
meltdown.
seasonally strong for dollar bounce right here, right now.
Yeah. So that, yeah. So
October volatility is usual for equities, precious metals. Anyway, we'll see what happens. Your mid-January time frame.
Yeah, so a 640, I put on a 640, March 640, 565 for $9.25. So you can pick up a, what is that, $75 put spread. And because of this, the relative steepness in the S&P, that it changes throughout the year, but it is always steep, meaning you're going to get quite a bit more from an implied volatility basis, which is just sort of the relative level of that option pricing that you're getting for the short put. So you buy the one that's a little bit cheaper, you sell the one, you might be buying one around a 17 or 18 implied vol, you might be selling one around a 25, 26. That's nice. That's going to help you. That prices nicely because you're getting a juicy, juicy premium for the one you're selling. So that's going to cut down on your cost. Now, as Samantha and I talk about sometimes, if you truly want crash protection, then you probably don't really want spreads. You want something with full convexity. So let me give you a quick example. I have a couple of people who own call spreads lately. And actually, I did as well. I had a call spread on USAR. I had all kinds of stuff on that. So that was one of my non-negotiables that worked out nicely. But I had a call spread. It was so interesting because as the thing started to take off and the rumors started to circulate that the government was going to get involved, that upside blew out. So I'm long one call and I'm short one that's now getting juiced up. And I'm not making money on this call spread. Sometimes skew and all that stuff that we have fun with, it can hurt you. Then the next day it jumped up further and they started to sell because people come in, they've bought upside, now they're going to monetize it, right? So sometimes you get that effect of if something goes high enough, people are starting to liquidate some of the positions that they bet on and that comes down. So what happened was I made money on the long delta and then the top one kind of got crushed. And so I started to make money on it. But skew can kind of mess with you, but it is a way that you can really cut down. If you sort of say, well, I think a reasonable sell-off would be 100 points on the SPY. Like, it wouldn't be pleasant, but I think it's not going to get much worse than that. And a spread will allow you to really, really cut down and focus in on a sort of range that you're comfortable with. But if you want full crash protection, then you got to just go out. And what I would do is I would take your budget and buy something way, way out of the money, and you can afford more of them because of that. You can afford more contracts. So that's a good way to kind of. So
and also the crash protection came in. Remember on Monday I highlighted that they came in $50 lower of size. We're talking 112,000 contracts for QQQ 555 kind of thing.
Yeah. My plan, and I remember having this chat with a bunch of mentoring students, and I said, listen, my plan is I think we're going to get a melt up. This was maybe 4 months ago. I said, I think we're going to go bananas. But what I'm going to do is I'm going to play it with cheap upside leaps, calls, things like that. And then I'm going to be adding downside protection to that because I don't know, like, something could break at some point, because when you get incredible exuberance, you can also get a corresponding reaction to the other. When too many people are on one side of the boat, then the thing is now they're not. You look at some of these sentiment indicators, although, boy, did you see the systematics? I mean, they are so, I couldn't believe that chart. They are absolutely massively into this market. So there are some indicators of a lot of people being in this market now. We know the hedge funds have come back again after getting it wrong. And on the other side, it's kind of one of the most disliked rallies. I don't want to use hated anymore, but it's maybe disliked or something.
I think distrusted is a better word.
Join Samantha and Hans at the next Macro to Micro Options Power Hour, held each Wednesday at 4 p.m. Eastern Time. Registration is free. Scan this QR code or click on the link in the description. Watch the full Options Macro to Micro Power Hour episode by clicking on the video here and subscribe to LaDucTrading YouTube channel for more content.